Welcome to this edition of IBFD's Tax Takes News and Views, bringing you the week's tax news in a nutshell. I'm Stuart Gibson, IBFD's Chief Editor, Global News in Washington, D.C. With me for our Beyond the News interview is Barry Larking, Special Counsel at IBFD in Amsterdam. On today's show, the U.S. finds that the French digital service tax discriminates against U.S. businesses, but declines to retaliate, for now. OECD members look to digital service taxes as Plan B, while some African nations adopt them as Plan A. And countries continue to grapple with a post-Brexit Europe. These and more, including Barry Larking's interview with Frans van Istendel, Professor Emeritus at Catholic University of Leuven in Belgium, an international tax icon, coming up on IBFD's Tax Takes. First, we turn to the top news of the past week, as reported in IBFD's Tax News Service. Getting 137 countries to agree to anything is a daunting task, but getting them to agree to a complete overhaul of the international tax system on deadline in the middle of a global pandemic might be a bridge too far. And yet the OECD continues to herd the 137 cats of the BEPS inclusive framework toward reaching consensus on solutions to the tax challenges arising from digitalization. They released the latest blueprints on Pillar 1 and Pillar 2 in October, opening a 2-month comment period that ended last month. The OECD then hosted a 2-day public consultation last week. The goal is to reach consensus on the main components of a plan by the summer of 2021. Among the many outstanding questions, perhaps the biggest are, what will the United States do, and what happens if no consensus is reached by this summer? Recent developments in the ongoing dispute between the U.S. and France do not give much of a clue about the answer to the first question. On the bad news side, on his way out the door, President Trump's trade representative issued a finding that the French DST discriminates against U.S. businesses, as do the DSTs of 9 other countries and the European Union. But on the good news side, Trump decided not to impose his threatened 25% retaliatory tariff on the importation of French luxury goods, even though France continues to collect its DST from large U.S. companies. And the U.S. has decided against retaliating immediately against the other countries with discriminatory DSTs. Think of this as a housewarming gift for the incoming President Biden. Whether the U.S. joins the Pillar Party remains to be seen as the Biden administration takes shape. All of this will take time. As the U.S. faces the darkest days of the pandemic and struggles to get approved vaccines into the arms of its citizens, global tax reform is hardly at the top of Biden's agenda. But time is something that neither the OECD nor its most vocal members are willing to compromise on, so far. While the French and German finance ministers recently expressed conciliatory views toward the United States, both have reiterated their position that consensus must be reached by this summer. So what happens if consensus is not reached by this summer and the deadline is not extended? Many OECD members, including France, Spain, Italy, and the UK, have already adopted unilateral measures, DSTs designed to pressure the inclusive framework members into reaching consensus and to serve as a sort of Plan B if consensus is not reached. If no consensus is reached, expect most of the remaining OECD members, including Germany, Canada, and Australia, to follow suit. At the same time, non-OECD countries such as Kenya and Sierra Leone in Africa have decided not to wait for the OECD. They have introduced their own DSTs, which took effect at the start of 2021, as their Plan A. Expect others to join them, particularly if no consensus is reached. 2 weeks after the UK officially left the European Union, the world continues to grapple with the fallout from Brexit. Most recently, the UK has updated the rules and procedures for obtaining relief from import duties and VAT for goods imported into the UK post-Brexit. At the same time, Croatia, Cyprus, and Spain have published guidance on resolving VAT disputes for transactions with businesses in the United Kingdom. Expect more nations to issue such guidance in the coming days and weeks. Turning to other news, As we continue to report, there appears to be no limit to the extent to which countries will go to provide tax incentives for investment and entrepreneurship. Panama has created a new type of legal entity for individuals that offers a 2-year exemption from corporate income taxes, among other benefits. And Zimbabwe now exempts from income tax real estate investment trusts that meet certain conditions. In contrast, other countries are adopting new measures and reviving old ones to raise revenue. Andorra has introduced a new carbon tax for 2021. Poland has reinstated the retail sales tax that it had suspended pending a court challenge. Denmark has proposed new measures to fight tax fraud, while Rwanda has introduced new transfer pricing rules to reduce base erosion and profit shifting, and the Isle of Man will now require self-managed investment funds to comply with economic substance requirements. And finally, everyone talks about tax certainty, but France has finally done something about it. Introducing perhaps the ultimate in concierge tax services, France will now allow companies to hire their own private tax auditors to determine whether they have complied with the tax laws. If, after submitting the private audit report to the government, they still owe additional taxes, the company can recover what it paid to the private auditor. Win-win. Now we go beyond the news for Barry Larking's interview with Frans van Istendel at Catholic University of Leuven. Barry.
Thank you, Stuart, for your informative news report. I'm Barry Larking, Special Counsel at the IBFD, and I'm delighted to have with me today Frans van Istendel, Emeritus Professor at the Catholic University at Leuven in Belgium, and also former academic chairman at the IBFD. As Stuart indicated, Professor van Istendel is one of the greats in international tax matters, but also in EU tax and economics, which is why we're very happy to have him back to talk about how tax may fill the hole in the EU's budget. Professor, the COVID crisis and Brexit are both bad news for the EU's finances. And by chance, both those things coincided with having to fix the EU's new long-term budget. Now, before we get onto taxes, could you briefly explain where in normal times the EU gets its money from and what it spends that money on?
We'll start with spending. The annual budget of the EU is, the last one, 2019, was 166 billion euros, which is 1.1% of total GDP. And that means that that budget is, in relative terms, 45 times smaller than the national budgets of the member states, who vary from 30 to 50% of their GDP.
Right. Incidentally, I understood that the US budget is 26 times bigger than the EU's budget. So perhaps that also puts it into perspective.
That's right. And where is it spent on? Mainly, of course, agriculture is still a major item. It's about 1/3 of the budget.
Right.
And then there is the internal market, there is digital and innovation. And the bureaucracy of the Commission and the Parliament, etc., that takes about 12 billion of the total budget.
Right, so that's what they spend it on. Where do they get it from?
The revenue for the EU budget is called the own resources. And we make a distinction between EU own resources and what I would call national own resources, because the basic idea was that the EU would have its own resources. But these EU own resources only represent 12% of the EU budget. They are customs tariffs and agricultural levies. And the main part of the budget, so more than 3/4 of the budget, are in fact direct EU taxes on national budgets in two forms. One is a contribution on the common value-added tax, and the other is just a charge in proportion with the GDP of the EU member states. And so that means that basically it's the EU financing has its source in the EU, in the member states' national budgets.
So even though it's called, even though it may be called own resources of the EU, arguably most of it actually comes directly from the member states. It's more like a tax on member states, I think one might say.
Exactly, and that's also why the member states are reacting in this what we call the juste retour, and that is what Margaret Thatcher made cry, saying, "I want my money back," because they are seeing how much from their national budget goes into the EU budget annually, and then they want to get that money back, and that's an infernal mechanism.
Right, and that's the normal kind of position, and I think that explains why the budget is normally a difficult issue to get fixed in the EU. What's caused the problems in getting the new budget fixed?
Well, the problem in getting the new budget fixed was a double problem. First, it was a problem of matching spending and revenue, so it was a question of resources, and it is also a problem of the rules of the decision making. The spending of the EU, because of the COVID crisis, the COVID recovery plan provides for a total spending of 750 billion over the first years of the multi-annual financial plan. And 750 billion, that's a huge amount. And then the next thing was that it was decided that 750 billion would not be reimbursed by the member states. They would not repay those loans. 390 billion of those loans would go to grants of the member states, so that were not subject to reimbursement.
So that explains why member states were less keen on, or at least some member states were less keen on agreeing to this whole package. It's not just the fact that the EU was borrowing, but that the at the end of the day, the EU would have to pay back the borrowings
exactly.
that was causing the problems. So what did they come up with then in order to solve that problem?
Well, there were two things. There is a general ceiling of 1.2% of the budget of the EU GDP to limit the EU budget. That ceiling was increased, and temporarily it was increased from 1.2% to 2% of the EU budget, of the EU GDP. And that was an almost doubling, and that was just to make repayment of all these EU loans possible, because otherwise that would not be possible. And the next thing was, okay, how are we going to fill this increase in the ceiling of the EU budget? And there were two options. One was to increase the own resources, existing own resources, that is, or to look for new own resources. But increasing the existing own resources would in fact mean that the EU would increase its tax on the national budgets of the member states. Now, the member states had already increased their public deficits dramatically because of the COVID crisis. So they didn't want to increase those deficits again just to repay the EU loans.
So the only option then was to introduce new taxes rather than, as it were, increasing new taxes or the taxes on member states. So what kind of taxes did they come up with?
Well, there were several proposals in the line. The first proposal was a plastic charge.
Was that popular?
Yes, to a certain extent, because it is an environmental levy. So environmental levies, of course, are more popular with the public opinion. That's quite clear. And it was also a levy that was not directly impacting on the national budget of the member states, because some member states do have such levies, but other member states don't have such levies. So this was a typical European levy that would not disturb too much the national budget of the member states.
Right, and are there similar taxes that were also in that kind of popular category?
Exactly, it's the carbon adjustment levy, because we want to reduce carbon emissions, and of course the EU is doing its best. But then, of course, we don't want to have other products from outside the EU which do not take into that into account, and they are polluting products, and we want to stop those polluting products at the border of the EU. Now that requires a carbon adjustment levy, and of course the EU is a customs union, and member states do not have the legal right to decide for the whole union to have such a carbon adjustment levy. So the only one who can do it is the EU as such.
So the carbon adjustment levy also doesn't take money away from member states. It's simply something new that they can all agree on. What else was there in the list of possible new taxes that maybe were less popular?
Well, the least popular of all is the CCTB. That is not officially
the common consolidated corporate tax base.
That's right. Yeah. The CCTB is not officially in the list mentioned in the political agreement of July of last year, but it was mentioned by the Commission, and it was in earlier proposals for the budgetary reform. Now, the problem with that is that the CCTB is a national tax. It's a harmonized national tax, but it's a national tax, right?
If and when it comes in, it will be. Yeah, just to make clear, it's not yet in existence.
No, of course not. But it is a harmonized tax of national corporate income tax.
Yeah.
Different rates of corporate income tax rates for the member states. Now, the problem with that, of course, is you cannot have a national tax, or having a national tax contributing to the EU budget. That is one of the worst methods. So the only thing which we need, of course, is for the EU budget is an EU tax that does not interfere with national taxation of the member states. So that would be an EU corporate income tax, but that's something quite different from a CCTB.
Is that does that have a realistic possibility of being adopted?
Well, there are two things about realism. There is legal realism and there is political realism. From a legal point of view, there is no way to introduce such a tax without unanimous agreement of all the member states. Plus also agreement of the national parliaments of the member states, because there's also a requirement that own resources should be changed in accordance with constitutional fundamental principles of each member state. So legally, without unanimity, this is not possible, and it's quite clear that member states at this stage will certainly not agree to it. However, once we have EU taxes, really not only customs duties, but plastic charges, carbon border adjustments, really funding an EU budget, then it will be very difficult to extend those taxes to other areas that are really of EU interest. And one of the things is that right now, of course, multinationals are making billions of profits in the internal market, and thanks to the internal market. And those profits are subject to national corporate income tax flowing to national budgets. But they exist only by the grace of the internal market. And the engine for the internal market is Europe. It's not the national member states. That's quite clear. And yet we are not contributing anything of those profits and benefits to the EU internal market.
So what you're saying is that there is a strong political and perhaps economic argument in favor of that kind of tax, and perhaps having started the ball rolling with the other taxes, the plastic tax and the carbon tax, perhaps that will give sufficient impetus to moving on to this more arguably ambitious type of tax. Well, I think that's a fascinating possibility, and clearly something that we should be looking at moving forward. And that brings us to the end of our brief discussion on EU taxes and their role in the EU budget. I'd like to thank our guest today, Professor Frans van Istendal, for highlighting some of the possibilities. But it's clear that there's a lot of work still to be done. And that wraps up this week's edition of Tax Takes News and Views, the week's news in a nutshell. And from Stuart Gibson and myself, thank you for watching. And here's hoping your week will not be too taxing.